Hello, everyone, and welcome back to the Property Trio, the podcast for the sophisticated property buyer. And I'm here joined today for our special market update episode with Cate Bakos and Dave Johnston. Good morning.
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 All right, let's get straight into it because there's quite a lot to talk about for this particular month. So we've got hot off the press, the September figures from whatever they're called this week. Interestingly, we've got some markets that are still performing, hangovers from 2024, peak of the market month on month, still delivering, and Darwin back on top after a small little hiatus last month. Let's start with you, Dave. What are the highlights for you? And maybe we can talk month, but also that annual trend as well, which is interesting.
Yeah, look, I mean, all capital cities are now moving forward in positive territory. I mean, look, September Hobart was only at 0.1%, so they're just ticking into that space. We continue to see Darwin leading the way at 1.7, but Perth and Brisbane have both rebounded in the last 3 or 4 months after being really slowing down their rate of growth towards the end of last year and early this year, but now they've jumped on board the property market train post the first rate reduction in February and are fully on board. So we're really seeing the start, or I would say towards the middle stages of whether boom's the right word. I mean, it grabs headlines, but we're certainly in a major phase of property market growth across the country off the back of 3 rate reductions and probably the expectation, it seems, with what's happened with inflation, that there may be another rate reduction early next year, looking less likely in the back half of this year. So yeah, that's I guess the macro view. Prices are rising all over the country.
And the RBA meeting minutes came out yesterday, as at the time of recording, and it was very interesting to note that it went against what perhaps the economists were predicting, because I think it was sort of like 94% chance that it would stay the same like a day before. But they're actually kind of saying, oh, look, it's probably a little bit restrictive at the moment, which is good news, because I think the last time we were chatting about it, we're like, oh gosh, like there could be a rate rise in the next 12 months if we have this sort of stuff happening. Did you have a look at that, Cate? What are your thoughts?
No, you're a step ahead of me, Mr. Mortlock. I haven't had a chance to read the minutes, and you know that it's one of my favourite pastimes.
Gosh, we're cool, which is why you should come to our live event, which we haven't released the date yet, but in the show notes, there'll be a link to register your interest. Well, let's talk about your home state then, because it's busy. Like everybody's talking about Melbourne. If we look at, say, the Pippa survey, it's the number one location. In our own data, it's just overtaken Queensland as the most populous state, with I think 32% of our investors buying into Melbourne, yet 0.5% growth and an annual rate at only 1.9%, which is even worse than Canberra. It's the worst performing market on an annualized basis.
Yeah, I want to chat about this because we talk about worst performer, but this data is median values. So what I'm noticing with all of these investors that are flooding Melbourne is the vast majority of them want to spend sub 750. You get your investors that can go to 1.5 or 2. I'm getting quite a few that are comfortable around that 950. And we've also had the deposit guarantee officially start on the 1st of October, and Victoria's threshold, or Melbourne's threshold, is 950. So we're seeing a lot of activity in that sub 950 market and from investors in that sub 750 market. And immense amount of activity. And so, of course, if we're seeing a lot of value growth in that segment of the market and we're not seeing a lot of activity at the top of the market, you will see median house prices sitting around, the sub 950. And, of course, this index is tracking median value growth. So I think the point that I'm making here is we're getting a lot of activity in the bottom and middle quartiles, and that doesn't necessarily show you, when this chart won't show you the performance that we're actually getting on the ground.
Yeah, that's a really important point. And we talk about it a lot because it's so important to understand that just because that data is saying that Melbourne is not doing very well, doesn't mean that people aren't making money investing in Melbourne. I'm sure that there are pockets that are already doing double-digit growth on an
Yeah,
annualized
there are.
basis. And we've
I can
got that.
It's worth
absolutely attest to that.
touching on, yeah, how Cotality tries to allow for what Kate's describing with its algorithms. So, like, it's not just median prices like a lot of them are. It models like the level of prices which adjusts for property characteristics. So, e.g., land size, location. So it aims the way they've built it, and Chris Joy was critical in building it, is so it's not affected by the sales mix of the month. So it just doesn't just rely on recent sales, and it also imputes the current market value of every dwelling in their database using modelled data. So it strives not to be impacted, like if most of the sales are in the bottom quartile or the middle quartile. But
Yeah.
how effective it is another matter. But you would imagine, yeah, if Melbourne is, it's still got a reasonably high median value, and most of the purchases do seem to be happening in that sort of bottom to lower quartile. You think even if the algorithm's quite amazing at trying to allow for that, you just still don't know
Yes.
how effectively it does.
Yeah, and
Good.
look, I've just sent you both the Cotality chart actually for the stratified dwellings index, so you can see as an example and a case in point, the Melbourne data is showing that the 75th percentile over the quarter has only moved 0.4%, but the 50th has moved 1.6% in one quarter, and the 25th has moved 1.1. So we're getting a lot of performance at that lower and middle end, which is exactly what I'm seeing. And it's the top quartile that's really struggled.
Yeah, you make a good point, Dave, but I wonder if that data is evidence that it's not that effective at achieving its aim.
Maybe.
And I think we're going to see a similar situation playing out in Brisbane because the head of REBA, Melinda, was in the newspaper talking about the sub-$1 million market, which is the cap that they have first home buyers, has done 50K in a month. So with their median, their median is a little bit below $1 million. It's not too far off. I'm on the wrong bloody screen now, which would be helpful. It's 969. So
And
you're going to
that's
see
including units too.
yeah, right, and their house
Yeah,
median
so
is
they
over
actually are
a
above
million.
a million. Yeah, yeah.
Yeah, so
Yeah.
there's going to be a flurry of activity below a million there from the first home buyer. So, like, there's a possibility that we could see the market continuing to grow, but maybe printing negative numbers. That'll be an interesting one to watch and a real test of the veracity of that algorithm. When we look at the change in dwelling values to the end of September 2025, obviously we get a little bit more flavour with the regions. Cate, is there any standout for you in those?
The regions, yeah, look, absolutely. We can see that regional WA has been a really solid performer. It's not showing us regional Northern Territory, and I could imagine that that would be flying off the page as well. Um, Victoria, it's interesting for the month we've been the underdog, which doesn't feel congruent with what I'm experiencing in our regions. I was in Geelong just yesterday, and I've been buying in Ballarat all year, and it's very competitive. We're getting a lot of interstate investor activity. We're getting these big buyers agent firms targeting these areas, and some of which aren't visiting. They're just getting the agents to send videos, but that's another story. I think what this chart really tells us is that regional WA, South Australia and Queensland, in that order, have led the chase for the year. And not surprisingly, the data's been consistently telling us all of that. But regions overall are just a tiny bit under the combined capitals for the month and for the quarter, but annually the regions have still been up across the board nationally.
And they are probably at that high point of the cycle of the differential between the capital cities and the regions as well, right?
Yeah, that's right.
So,
I also
Cate,
think it's interesting how we are rippling up towards the middle, the 50th percentile starting. Actually, nationally, the 50th percentile is now the area that's growing the most. It was the lower 25th quartile. Um, and so I wonder if that's going to transition into the 75th or the top quartile over time. So that seems to be the way this market cycle is moving. Historically, the upper end would lead the way in falling and recovering, but it seems to be going in a different direction this time. And you can see Darwin, we had been commenting on how it had been its lower 25th quartile, then the 50th middle quartile, but now it's the most expensive end of Darwin is now showing the strongest growth. So as that is the market leader in terms of this cycle, I wouldn't be a surprise if other capital cities followed that same sort of pathway.
that is an interesting thing to watch. I was chatting to one of the owners of, let's just say, one of the big volume buyers agent businesses, and sort of putting the thought experiment to them that if they're going into a market like Darwin, for example, and they're transacting in that lower quartile, then is it really just those cheapies? They grow in value, and maybe there aren't the people to compete with those if the investors leave. But their sort of premise was like, well, no, what actually happens is that sort of pushes the people that were selling those houses into that sort of middle upgrader market, and there is kind of like a flow through effect. And I don't know, I was open to that, but perhaps skeptical, but the data's maybe showing that to be true.
Yeah, it looks
Cate,
like it's starting to in Darwin.
Yeah. Cate, you've thrown in an interesting chart for this market update, which is which market values have changed the most or least amid the rate cuts. And we know that as soon as we got rate cuts, your phone went off the hook, which is probably a cautionary tale for people that are just, sitting on the sideline waiting for X to happen. The best time to buy is maybe like yesterday and today.
Last year.
Exactly. So what was an interesting sort of take on that data? Where are the areas that had the biggest uptick?
Well, whenever we get these monthly chart packs from Cotality, they have a chart of the month at the back in black, which is always interesting. And this particular month, and it came out 4 hours ago, hot off the press, the values that have changed the most amid the rate cuts have almost all been in Darwin. So we've got 9, 10, 11 markets that they've chosen. 2 are in Perth and the rest are all in Darwin. And we're seeing value growth over a very short period of time, ranging between 20% and 16%. Now that's incredible. And then when we look at the regional cities, so that I've picked out some capital city locations, but when we look at the regions, it's a bit more of a mix. Boggabri in New South Wales has also done 20.1%. We've got Rochester in Victoria at 19.4%, which is a little bit of a surprise. And the rest of it is broadly WA, SA, and a little bit of Queensland. But we're seeing anything between 15 and 20% there as well. They're really significant growth figures. Now, if we look at the lowest change, the worst performer over that period has moved back 7%, and that's Milson's Point in Sydney. Now, we all know how very expensive that location is, and Kirribilli is number 2. So we've got, when we contrast the growth areas at 20% to 16%, and then we look at the worst performers, they've gone clocked negative 7%. It just goes to show that the uplift is greater than the downside there, and that's not unusual. And then when we look at regions, the worst performing region was a part of New South Wales at negative 9%. So again, not nobody would be excited about losing almost 10% when rates have been cut, but they're not a patch on the growth figures that have been clocked.
It's interesting to give a bit of context. We're talking about 9 markets in Darwin that have grown 15% or more, and 2 of them at 20%. And that's between February and September. So we're not talking about a year, yet the annualized growth rate in Darwin is only 12.9. I say only 12.9. That is a lot. We should understand that that is not a normal growth cycle, but so many of the markets are outperforming that. And Dave, one thing that I noticed in this that you might have a thought on is that the places that have decreased the most or the lowest change are bloody expensive locations. So when we have a market rate cut, what are the wealthy people doing? Do they have much more exposure? Do they actually benefit from higher interest rates due to the nature of their investments? What do you think's going on there?
It's a good question. I'd say it's just a lag. I'd say that it's the trickle effect where the markets that are moving have been the bottom end, as we were just talked about, and then they've transitioned to the middle quartile. So I'd say it's just, I imagine it's a lag effect that's going on there. But what's also interesting is you may recall that at Property Planning Australia, I've had us tracking how the capital city median prices have been changing since the first rate reduction, because I was really keen to see which markets were moving, which ones weren't. Seems like CoreLogic got on board and started doing that as well in the last couple of months. But so through that process, what I discovered, because we were tracking how much the prices had changed in terms of the median value, and then I figured out that our numbers were different to CoreLogic's. And so then when we unpacked it further, when they're saying how much it's changed, they're not actually commenting on the median changes of the capital cities. It's relative to their index. So, for example, like because I wanted to see particularly how much Melbourne's has changed. So Melbourne had changed 4.3% at Feb 25. Its median, according to CoreLogic, was 772, and for all dwellings, and then it was 805 at September 25. That's 4.3%. But if you look at we noticed this a couple months ago. I just haven't shared it on air or with you guys, but they've got Melbourne changed since the first rate cut is 2.9%. So, what it's a reminder of as well is take everything on face value in terms of, or with a grain of salt, when it comes to median values, when it comes to changes. They're just one piece of data. They're not. I mean, because like if we also then look at PropTrack had for September every capital city doing 0.5%, except for Darwin only doing 0.4%, Sydney doing 0.7%, and Hobart 0.8%. But at Perth and Brisbane and Adelaide and Melbourne and Canberra are all on 0.5%. So it depends where you're looking to in terms of what you think is happening in the market. And that is just a reminder of how it's all cut up and, cut and sliced and diced differently. And so just to look at different data sources when we're, I guess, making decisions or interpreting what's happening in the marketplace.
Every now and then the RBA will talk about housing and they'll talk about the indexes of different data houses. I haven't seen that for maybe a year or two, but it'll be interesting to see who they reference, who they cite, because if they only talk about cotality, then that's a fair endorsement that they don't have faith in the other ones. And if it's good enough for the RBA, I suppose it should be good enough for us, right?
Yeah, absolutely.
Let's talk about I love the data about, basically everywhere is at the peak of the market except Melbourne, Hobart and Canberra. Melbourne's 3% down. So that was March 22 for Melbourne. Hobart still 10.4% below the peak.
I've contrasted last month to this month. So if you look on the right-hand side, you can see these underdogs gaining traction and getting a little bit closer to their peak. So last month Melbourne was at 3% down. This month it's 2.7, which is slowly getting there. And same goes for Hobart, 10.4 and now 9.5. And I contrasted them just to see, to showcase the pace that they're tracking, even the slow ones. We're getting there, I suspect, by Christmas time. Aside from Hobart, I think Sydney and Melbourne and Canberra will finally potentially be at peak, which is really interesting. And the one that's really struggling is regional NT. They're quite a way off there, even though Darwin's going gangbusters.
Yeah, Darwin's currently at the peak of the market, but the regions have got a long way to go.
And it's been since April 16 that they were at peak. So 9.5 years and tracking to see them get back to where they left off, which is a really important point to make. You can see when an area like Northern Territory in a city like Darwin is finally doing a lot, this illustrates how long it didn't do anything for.
Yeah, and how long you may have to wait if you're buying at the peak of this cycle, which is a bit of a concern. When we had the Perth boom, I think it kind of reset investor expectations, and everyone's wanting that instant sugar hit, and I think that's why we've got people diving into markets like Darwin. I was speaking to a buyer's agent the other day that generated something like 8% growth from a client, and the client was upset because it didn't get the 12% that some other market would do. And he was kind of saying like, well, that's a very blue chip market, so I would take that any day over, an extra couple of percent in an area that hasn't got long-term fundamentals. We talk about Hobart because it started to enter the chat for these impatient investors, and we did a whole episode on mean reversion, which Anne-Marie might be able to chuck in the show notes. But with Hobart being, you're correct, Cate, it's 9.5% below the peak rather than the 10.4 it was the previous month, but it's still a long way off, and it begs the question, like, when is its turn, if that's the way to even talk about a market? Like, there are turns, like there's this queue where they're all lining up. It's go, all right, Hobart's here, like I haven't had a go for a while, so it's my turn. But yeah, there's people that do talk like that in the forums, and I think we've got to this point where fundamentals can sometimes come second to herd mentality, because we're talking much bigger herds now. Like, we've got big groups, big aggregators. So I wonder when it is its turn.
Well, we've got to have a really good reflection on what happened to Tasmania during lockdown. A lot of people, like a huge number of people, decided to do the move down there when working from home was completely normal and looked like it was going to last forever. And that's not the case. It's not what's happened. So I'm questioning that rebound, and I'm questioning the push that we had from a capital growth point of view down there. It was unprecedented, and we've used that word a lot throughout COVID. But I think Tasmania and Hobart, Launceston, and some of the other cities are really good case in points of areas that had a bigger peak than they ordinarily would have.
We've got a fair bit to cover, so I wouldn't mind changing tact and going into the rents side of thing. What's interesting to note, and we've just sort of referenced that, is that we don't necessarily have the data of investor versus owner-occupier transactions, but we have a fair idea that it's investors that are going gangbusters in Darwin, yet Darwin is the top in terms of annual change in rents for both houses and units. And Dave, it was a weird phenomenon for us to observe in Perth, where we had a fair idea that was an investor-driven market as well. And you would kind of think, as more investors come in, there's more rental availability, which should put sort of downward pressure on the prices, but it was going up as well. That sort of seems to be a weird phenomenon that is happening with Darwin. Is it a lag effect? Have we struck on something weird that is kind of an immutable fact of rental growth?
Seems to be, doesn't it? It's now happened with Perth and Darwin. I don't know if it's more likely to happen when it's in a smaller populated capital city, and so therefore it'd be good to see if Melbourne or Sydney went on a strong run if the rents started to outpace, and therefore we could see it's a consistent occurrence across the bigger capital cities as well as the smaller capital cities. But yeah, look, that's probably what I'd need to see to I guess believe that is a consistent pattern that happens.
And Cate, we often sort of do understand that yields can be a predictive measure for capital growth, and we've got Hobart humming along pretty hard for houses and units, really in kind of second place at 6% for houses and third place at 6.9% for units. Could that be an early stage indication that as those yields continue to grow, investors will start looking for it? Because I know that people are getting tired of these 3 and 4% yields.
Look, I'm not willing to call it yet, Mark. I think a lot of activity that we're seeing in Hobart in that data are people selling out, and if you've tried to get an Airbnb down there, it's very, very difficult. So we've seen a lot of holiday places that were doubling up as Airbnbs being liquidated. Not willing to call it at all. I think since interest rates have gone up, and even though we've had some rate cuts, comparatively the interest rates are far higher than what they were during COVID times when people were inclined to buy a holiday house down there. So I'm not there. What I did notice out of this chart is everything's shown a little uptick of late, except Adelaide. In both houses and units, we can see that Adelaide has dipped down, and I wonder what's going on there.
Well, Adelaide saw a huge share of investor activity, right? And it's not following the pace of Melbourne and Perth, and it was kind of the three of them were the gangbusters of 23, 24. So I wonder if that is a bit of oversupply putting downward pressure. I don't know, Dave, what do you reckon?
Yeah, I think it could be a sign that Adelaide's starting to reach a peak with prices and rental growth that its economy and the population will allow for. It had the mildest rental increase in the past 3 months, only 0.4%. So Darwin had the greatest at 2.9%. So that's rents rising by an annualised amount of 12% if that was to continue. Hobart has moved into second place with 1.9% rise in the last quarter. So it is I think it's a sign that potentially there might be the Hobart property market might be about to rebound, but that we need to see some other data sources to make that call.
And Cate, the rental stuff is something that the RBA are a little bit worried about because it has a fairly big weighting in our basket of goods CPI. What are the concerns if rents continue to grow?
Yeah, we've had a reacceleration. And so the issue that we have there is with that increase in rents, it certainly shows up in our CPI data. And if that feeds into inflation, and if the inflation figure is outside of the band, that could put pressure on interest rate increases as opposed to cuts. And it will certainly question whether we're having any more cuts. So they're keeping an eye on it. It's a big portion, as you just mentioned, and it feeds into the data significantly.
Be interesting to keep an eye on that Hobart rental yield as well, because it's in second place from a capital city perspective, second to Darwin. Let's have a look at the vacancy rates because we're reporting a new record low.
The one change that obviously I keep an eye out for is the gross rental yields for all dwellings. Adelaide, Brisbane, Melbourne were always hovering at the same level, and Adelaide and Brisbane are both now at 3.6 and Melbourne is at 3.7. So that's the first time this month that we've seen Melbourne break away from the two of those. And or more should I say, they've contracted, and that's because they've had such strong value growth that hasn't kept up with their rental growth. So, believe it or not, Melbourne is the fourth least desirable rental yielding city now, which we haven't seen in decades. Melbourne and Sydney have usually both been pretty awful, but we've got Adelaide, Brisbane and Sydney below Melbourne now.
And if we do finally see some capital growth figures that we know are happening on the ground, but not necessarily in that index, that may bring that yield back in line, but it remains to be seen. I do think it's really quite interesting that we see the rental uptick when we see investors enter a market. But we've talked about that before, that it could also be a reset, because if you're bringing a new property onto the market, it's going to be rented at market rate. But if it's an existing property that's been a rental for 2, 3, 4 years, often they drift away from market rental, either by maybe the property manager's not being proactive, maybe the owner is thinking, this tenant's looking after the place, I don't want to be, a jerk to them. So maybe that is an explanation for it as well. But we've got super tight vacancy rates in Australia right now. It is a bit of a concern.
Yeah, well, it's interesting because Melbourne's the loosest at 1.8 this September. I feel awful when I see people queued up around the corner, like they're waiting at their favourite bakery and they're actually trying to get through rental property. And I'll see a board and I'll think, oh gosh, that's a busy open for inspection. And then I realise it's not a sale, it's a full lease. And that's Melbourne. So I cannot imagine how tight it is in some of these cities where, I'm looking at Hobart, 0.4, Darwin, 0.7.
That's crazy, isn't it?
Perth, 0.7. Brisbane, 0.9. So that means that these tenants that are queuing up, it's less than 1 in 100 houses are available. It's really, really tough.
Yeah, and it's just we're not building enough houses, and some data came out during the week in terms of the apprenticeship completion rates, which are declining. So we have less people doing the jobs to build houses, and those that are, a lot of them are caught up doing infrastructure work for government. So the number, obviously the population's increased, so the apprenticeships should be going up year on year. They're actually 30% lower than they were 10 years ago in terms of apprenticeship completion. So that's a huge fall in the number of people that can help us build houses. So, all these factors go into what's happening here in terms of vacancy rates or prices increasing. There's a number of holes in the bucket that the government, needs to try and sort out. And, we know that they don't like bringing in migration into Australia for apprenticeships. And, look what's happened. We've got 38% less people completing apprenticeships. And, that has a real impact on housing supply.
Yeah.
It's a bit of a mess. Construction industry still number one for insolvencies of any other industry. We're talking thousands of them going out of business each year. The supply issue isn't going to get any better soon by the look of it. So we'll be just talking about the same sort of stuff. We just do the stimulus first home buyer, and the back end is just in the too hard basket, it seems.
Well, I mean, you've got to help employers. Employers face a long payback periods, 2.5 to 3 years before an apprentice generates a financial return for them. And lots of them drop out before they complete their apprenticeship. So,
Yes.
Where's the incentive for the employers to hire young people into these roles? And they're driven up by high pay packets. So, plumbers, electricians and bricklayers in Perth earn up to $250,000 a year. Okay.
It's crazy.
And then, there's a developer, Nigel Satterley, was saying that his lead tradespeople, so if they're heading up a team of about 4 tradies, they can earn up to $500,000 a year.
Bloody hell. Like that, I mean, that is crazy. That is above the ABS data that we see for surgeons and anaesthetists. Like it's just insane.
Yeah.
It just goes to show the extent of the problem. And then, when you have people in that position, where's the incentive for them to get behind the support for, new trades or let's say trade-based immigration? They're going to want to keep that as tight as possible, which makes sense.
Yeah.
We all sort of tend to work in our own interests.
And if the costs are that high, how hard is it to make a profit on building new homes?
Yeah, exactly. And the differential between established and brand new is still too big, right? We need to get to the point where it's actually cheaper to get a block of land and build something than it is to buy the established house next door. I think we're still a million miles away from that.
Yeah.
Yeah,
A lot of work to do.
Anyway, that's a topic for another episode, perhaps. Cate, let's talk about sales and listings. What are your observations?
Okay, so let's start with sales. We've had a little bit of an uptick of late, above the 5-year average for sales activity, which is great, and we all feel very busy. But when we have a look at listings, total listings are still substantially underneath the 5-year average and below last year and the year before's average. But when we look at new listings, it's only just in September tricked up a little bit and is almost on par with the 5-year average. And what I can see is last year and the year prior, we're tracking quite a bit above the 5-year average this time in their calendar years. So listing activity, while it's not matching last year and the year before, it's matching the 5-year average right now, but it's only been very recent. And at the coalface, I have seen some more good listings come about in September, October. And anecdotally, the agents are talking about having a later run and lots of purchases and sales taking place at the same time. So clearly, vendors who have been sitting on the fence waiting to do something are doing it now, and that in turn will generate a lot more new listings. So I'm predicting we're going to have a late spring.
Right. So a pretty awful run into Christmas for you.
We'll
There
be
won't
busy,
be much
yeah.
downtime.
Yeah, no downtime.
So with every market, apart from a couple at the peak, I'm interested in why there aren't more listings, people taking advantage of that position, or is it still the concern that when the volume is low, the problem is, well, where do I go? I can sell my house and
That's
I'll
right.
make good money, but where do I go?
Total chicken and
Well,
egg.
I think, Melbourne is still below its peak, so people are holding off in Melbourne. I think Perth is still doing very well, so people are holding off in Perth. Darwin has only just got above its peak of 10 years ago. So those three cities are all quite low on listings. Sydney has only just started to move into sort of peak territory, so people are probably holding off to some degree as well there. So I think there's different reasons why the listings have been, slightly down. But I do think the big story is the sales activity. Through the September quarter, it was 7.3% above the previous 5-year average. And we know when markets are flying, we have the higher level of sales. So there's a big correlation. So, I think that's another sign that the market is going to continue to push forward quite strongly. There was 7.3% up in sales activity over the September quarter.
Well, people are enthusiastic and buoyed, which is a perfect segue into consumer sentiment, which we haven't spoken about for a little while because there's been some issues with the data. What are people thinking in the households about the economy, about their budgets, and about housing?
Well, sentiment was down this month, and the consumers appear to have been rattled by recent updates on inflation is the headline, and I'd absolutely chalk that up to an accurate read on what's going on. When we had talk about more interest rate cuts this year, I was getting absolutely slammed with inquiry, and as soon as the rhetoric changed to we might not have another cut this year, it's calmed down. It's still busy, but it's nothing like what it was. I was feeling quite overwhelmed by it. And the data actually illustrates all of that. In fact, the only measure this month that's been significant and increased is interest rate expectations index, which is a really interesting one. That's moved from 88% to 101.7%. Now, the question around that point is interest rate expectations index. Is that consumers expecting that we'll have a cut, or that we'll stay still, or that we'll go up? What is that figure actually telling us?
Yeah, Dave,
It's their
over to you.
expectations for variable mortgage rates over the next 12 months. So they're feeling
So what would
overall
have
a bit
made
more
that
positive.
go up? Yeah, so in September at 88%, we were all talking about interest rates being cut, and now we've had the interest rate expectations index increase markedly in October, and that was the one that had me scratching my head, because I would have thought last year we were more optimistic about a rate cut.
Yeah, I think it can be just the timing of the survey, reading their notes. Like some cities, they'll do the survey at a different date to another, and then the inflation data will come out, for example, and not being as positive as would have hoped. And then they see the numbers change in the survey, but it all goes into the one outcome set of numbers for the month. So yeah, it's a little bit of a weird one, but I guess it makes sense that it's popped to above 100 in terms of thinking, okay, we've already had 75 basis points over the next 12 months. We're thinking there'll still be probably one more rate reduction. So, I'd say that's what's going on there.
Yeah, it's a bit of a confusing one, but I think on the back of the meeting minutes, I think we'll see a flip. Like there was a fairly high inflationary print where we're kind of thinking, oh gosh, like is that the end of the cuts? Now we're kind of getting the RBA saying we're still quite restrictive. We're waiting for it to wash through, but they're using the word restrictive, and I think that'll channel through to the media outlets, and the people at home will hopefully have a little bit more positivity.
It's worth noting the house price expectations index. So what people expect house prices to do across the country in terms of rising, 171.9 is the highest recording in 15 years.
Yeah, right.
So, you mentioned the herd mentality. The herd thinks that prices are going to rise at a greater level than they have in 15 years. That's not to say that will happen, but you'd think if that is the highest number in 15 years, right, prices are going to continue to rise. And just with time to buy a dwelling index, and it was the same last month, but I'll just say it again this month, Victoria was the most positive. Victorians were 108 on that. So Victorians think now is a really good time to buy a property, which, you would suggest would lead to more activity in Victoria.
Yep.
Yeah.
That'll be an interesting one to watch. We don't have some updates from ABS on the lending side of things, but given that's your day-to-day, Dave, what are your observations and what data have you seen in terms of lending figures?
Yeah, look, in terms of observations in the business, there's a lot of activity with investors, and people have been buying a lot in the last 3 to 4 months. We had our busiest settlement month ever last month, and so really that was off the back of activity from the early rate reductions. And that has plateaued a bit with the reduced expectations on rates falling a lot further. So that's what we've seen on the ground. In terms of actual number changes, there was nothing really too much to stand out. I mean, owner occupiers quarterly change was 2.4% versus investor 1.4%. So I imagine that's coming off the back of the extra stimulus for first home buyers is bumping up those numbers. And so that's probably the main thing that's happening, at the moment. That's going to have a huge impact on markets, actually, the government bringing that forward to October 1st, bumping up the prices, having no means testing. That's going to drive the market up to those price points in each capital city for at least 6 months. Like if you're an investor, I'd be looking at around the price point just above where they cap out, because you're going to have much less competition.
Yeah, interesting record month for settlements. I mean, good news for you, especially mid-renos. Are we upgrading to marble entry floors from Italian quarries, or what does that mean for the household?
Look, there's a few variations already, Mike, denting the pocket. There's a little bit of marble going in around the kitchen bench and a few places, but no, not making too many extra changes, trying to stick very tight to the budget.
I just did a podcast yesterday on construction variations, actually. I'll send that to you. You might need some help to keep them under control.
So look, just one of the things that's putting our interest rate reductions at risk is the rising cost of labour. So, and that could cause our interest rates to stay high for longer. So the Bank for International Settlements put out a paper just in the last week or two, and labour costs are growing faster in Australia than in almost any other advanced economy. So that's making it harder to tame inflation. And so they found that among a group of just 3 advanced economies, Britain, Norway and Australia, where the nominal unit labour costs were growing faster than 4% per year. So we're one of 3 countries where that's occurring. And the difference between wage growth and productivity, which rose 4.4% in the year to June, according to the Australian Bureau of Statistics, is well above the pre-COVID average of just 1.8%. So what happens is if labour costs keep rising at a much greater rate than productivity, then companies keep putting up their prices, which then increases inflation. So, this is a big risk for us with regards to our interest rates.
And we saw last month wage growth was led by the public sector rather than the private sector. Not a huge difference, but interesting. We've had quite a lot of enterprise bargaining happening from big groups and unions and that sort of stuff. So we're paying more to get less, more than we ever have, it seems.
Yeah, I think that's right. And also, most of the new jobs have been created in the last couple of years in the government sector, the public service, and the productivity levels in the public service are much lower than in the private sector as well. So it's not where we need the new jobs being created.
I love it when stereotypes are actually backed by fact. We all have that quintessential argument about that, like, why are there 4 people standing around watching a man dig a hole in the bitumen on the side of the road? I'm like, well, yeah, that is actually a problem.
Yeah, when you factor in it's public servants creating those numbers as well, to say that public servants don't work as hard and aren't as productive. So you've probably got to believe the numbers, don't you? In a good little bit of news, I mean, just barely, but productivity rose just for the first time in a while from 99.6 to 99.9. But in 2022, we were up at 105 as the measurement of productivity, which had been growing basically for 50 years and is the main reason why we have the standard of living. It's a main driver of standard of living is the increase in productivity. But so we had a tiny little bump up, but not a lot.
In the age of AI and all, which is supposed to be, way bigger than the Industrial Revolution in terms of productivity increases. So, it's got a case to answer for. We're not there yet.
Not there yet, are we?
Right. Well, that was the month of September. Thank you very much to my to lovely interlocutors for downloading all of the goods on that one. And we'll see you again next week. And we've got lots of good content coming up. And as we run into the end of the year, we're going to be able to have a look at our report card for our 2025 predictions. And we've got the 2026 ones coming up. So that's always fun. And depending on how I do on that one, I might be sick that day. But someone will be here with a case to answer for.
Good
Thanks,
on you.
guys.
Good to see you.
See you later.